Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They've also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces, even within an IRA.
Welcome back to Golden Rule Radio. Gold touched 1,700 this week today, and silver pushed just below 26. Platinum has been pushing lower as well, down to 1170, and is testing the intraday low that set a few days ago. Palladium flat, 2350 or so. And so we're going to talk about what gold's doing. As we've predicted on the show, gold's sliding lower, and where it stops, that is the big question here.
Well, we're certainly coming up on the first opportunity for gold to take a break. You know, we've been rather bearish the last couple months, and maybe I should amend that statement.
Short-term bearish?
Short-term bearish in the middle of a very long-term bull that we expect kicked off back at the end of 2015, beginning of 2016, taking us from 1050 all the way up to 2100. So to see gold pulling back, we've broken through a couple of the potential support lines, but they're very shallow. You know, the short-term 382 fib was up at 1835. The short-term 50% line, which was up around 1765, and we've been making this brief stair step down since we hit that peak back in August. Well, we're coming into the first real test of the bears in this gold bull market, and that's coming up at around 1690. Now, 1690, that's your short-term 618 fib, short-term being the start of the recent rise last year in March until the end in August, where we went from around 1445 up to 2100. So that's your short-term 618 fib, medium-term 50% line. Now, the medium term began back at around 1270 in about May of 2019, and this would have been the last bottom we put in before we confirmed bullish back in 2019, and that's going to be your 50% line on the medium term. But here's what really matters. This is your long-term 382 fib. So this would be during the duration of this first stage of the bull market in gold. This is the first potential correction point that you would expect to see in this type of move back down. All three of those time frames lining up between 1688 and 1690. So anytime you see a number of price indications all kind of lining up at the same place around the same time, I argue that adds a lot of strength to that being a very strong support level. Now, there are some below it in gold that it obviously could still continue down to. If you look at the long term, a 382 correction is very, very shallow. So even though it feels like gold has come off a few $100, this is why since about November of last year, we've been telling people it's very likely we could see gold continue to stair step down, and that's exactly what we've seen. So excited to see what happens. I would expect to see gold hit this price within this next week, and then we'll have to watch the price action over the following weeks to see how it responds.
Yeah, that's great analysis, Miles. That's going to be really helpful, especially as we go forward here in the next few weeks and months to see if this does stop here. I think it's quite likely that gold may finish this downward correction right about where we are around 1700. This might be it. So I don't know that I'd be waiting for lower numbers, because I think once it finds support and turns around, it's going to go up quickly is what I would assume. The 1700 level, 1690, 1680, there's so many lines that converge at this level right about where we are that I just don't know that I would wait in a market where you've got all these inflationary pressures, all the things going on in the world. I wouldn't necessarily be waiting for 1650, 1600. I don't know that we're going to see it. Adding another line to the chart, the trend line along the two major bottoms that we saw puts us right in where we are. So you've got so much congestion right here around 1690, 1700 that this could be it. I'm not sure that I would be waiting for lower numbers to be entering into the gold market.
Yeah, I totally agree, Robert, and I've had that same conversation with clients. Don't get discouraged if we see it bounce off of here. We oftentimes see double bottoms or even triple bottoms, right, as you guys do the analysis. So even if this is the bottom, it doesn't mean it gets touched one time, never to see it again. So there may be an opportunity for some patience here. Oftentimes, we are big fans of dollar cost averaging in on positions, on sizable positions. To Robert's point, this is the type of environment where you do far more than a normal percentage on a dollar cost average in percentage. This is half of it or more. You guys have used the term back up the truck. And these are those opportunities. I'm very excited about this, and do not get discouraged by any of this short-term bearish type of activity.
Yeah, I completely agree. I mean, in the last couple of weeks, we had Rob McLaughlin in here talking about some of the more long-term things, just given his duration in the market. And he brought up something which is a different investment approach than I take, or a charting approach, but it's one I still pay attention to, and that's the Elliott wave theory. And there are Elliott wave theory arguments that does see gold even coming a little bit lower in the midst of a very strong bull market. So there are other price levels. 1590 is another good option if it were to continue down, and even all the way down at 1445, which is an Elliott wave theory. But like you said, it's about dollar cost averaging in, because you can see where the steps in the staircase are. That's very easy. You know where you're going to find support. You know where you're going to find resistance. The hard part is, of those 6 or 8 or 10 stair steps, you never know exactly which one they're going to turn at. So out of 6 or 7 or 8 steps, you find the 3 or 4 that make the most sense from a number of different angles, and that's when you make large positions. You take larger percentages of positions than you would the other ones. So 1688 to 1690, I certainly will be buying some gold over the next week, and I definitely encourage some other people to as well.
Part of the reason that I think that you might not see lower comes from this last year during COVID, when the world shut down in March. Gold was volatile around 1600. And when it first pushed into 1600, it sold off, consolidated around 1560, pushed through 1600, came back, pushed through it again, came back, pushed through it again, came back.
Right.
I mean, you've got all this congestion that's already traded throughout this 1600 number.
Right.
Plenty of orders went filled, and I doubt there's many unfilled in that range. So you already had that congestion. You already played with 1600. And once it moved higher, what you didn't play with very much was 1800 to 2100, which is why I think we've seen the market coming back down, drifting back into here. But you do have so much congestion around 1700 in April, May, June, July, that may be it. That seems like there's been enough trading through the 1600 range when we were there, and then the 1700 range when we were there, that this may be it. So I'm not waiting. I think that if we do go to 1600, look at where the bottoms were, the previous dips down. It doesn't stay down there. So even if you do have this sell-off into the 1600 range, I just don't think you're going to have more than a day or two to actually execute on it before you're right back up to 1700.
Well, and you look at how aggressively the decline in March down into the 1450s came down, and how aggressively it turned right around. One of my favorite things to consider when I'm looking at these market conditions is what you just brought up, and that's the idea of pre-standing orders. And the speed at which it came down and turned around and shot right back up just within a couple days back in March of last year tells us that at that break point in the mid-1400s, all of those orders very likely got filled. And therefore, you see, like you said, that fist fight up into the 15 and 1600s, tons of standing orders getting filled. The only thing that's still going to be standing there is new stuff that people have added since then. So I do agree with you that I think, given the vast number of different pricing indicators, channel indicators, 3 different time frames with different Fibonacci numbers all lining up just sub 1700, it's not a 100% chance, but it's about as close as you're going to get when you're speculating on a market.
Yeah, I appreciate the in-depth technical analysis, and that answers the question as to where are we going? Where do you guys see us pulling back to, or where do you see support? The other question that we're obviously being asked 50 times a day is why? Why are we seeing this happen right now? So let's touch on that before we switch metals,
because charts don't care about your feelings.
That's right. And that's the Miles response is
neither do computers.
No, they don't. Computers
Algorithms definitely don't care about your feelings.
And that's part of that answer. Why? It's healthy technical trading. So this is predictable in many instances. It's healthy, it's normal, but it can be driven. The one thing that we can't predict is timing. But what you do see underlying price movement a lot of times are the fundamentals. And the fundamentals right now are things like a little pop in the dollar, as we predicted on the show. You've got the dollar index over 91. That's going to put downward pressure on gold. But you've also got competition with gold in regards to allocations from investor portfolios, namely Bitcoin and Treasury, some other alternative investments that are garnering a lot of attention right now. And that 10-year Treasury note yield to maturity shows that interest rates are going up. We're not talking about the Fed policy rate or the LIBOR, but what you have is this 10-year interest rate that has doubled since August, since gold peaked in August at that all-time high of 2080. Since then, the 10-year Treasury interest rate, the real interest rate, has been climbing, and that's actually short-term bearish for gold. It's going to draw big money into Treasuries. And the reason that that's happening right now is the CPI isn't moving yet. The nominal rate is moving with inflation expectations. What it's telling you is there are inflation expectations. Let it support your reason and the cause for investing in gold. But it's telling us, look, we know inflation's already real. We've got food and fuel and copper, lumber, commodities in general are starting to run, but the CPI is not reflecting it yet. So that's what's not being indicated in that measurement on the Treasury yield. So those are some of the big reasons as to why we're seeing this. Nothing has changed. I'll tell you another thing that excites me fundamentally is normally when you see a big pullback in gold like that, if it's true, if it's a fundamental retracement where real rate of return is starting to turn positive, silver's going to outpace it to the downside. And it's not. The ratio has been stuck at 65-1. And with that, let's transition to silver and show us what's been going on this week.
Yeah, commodities are a great segue into silver, and we talked about oil and copper last week because silver's telling a very different story than gold. Silver, we've seen this channel pattern up. What I've found, at least watching charts in a number of different markets through the years, is that reversals happen quickly, continuations take time. Whether a continuation is trailing down like gold has been, or a continuation is pushing up like silver has been. That tends to be what I've found is a reversal. When bears become bulls and bulls become bears, it tends to happen very rapidly. And we're not seeing that. So I think we are seeing a continuation in gold. We're certainly seeing a continuation in silver. Silver's now made 3 touches up, setting a pretty defined trend line floor. And as you can see here, silver is now at the 50% line between where we put in that bottom back in November and then where we put the top in up around $30 at the beginning of this year. So silver is marching towards that $30 high. I would like to see it tested again. I would like, obviously, to see it break through because of what we talked about in other commodities last week with Rob. I think it's very likely you're going to see silver continue up and you're going to see platinum continue up.
So then the next question is why? Why would they bounce? We know where they will probably bounce to. We've got the technical analysis. Some whys, okay, passing another COVID stimulus will certainly create a pop, right? That can drive the dollar down. It can drive gold up. If the equities markets start to roll over and interest rates continue to climb, the Fed's going to intervene. That will drive gold up, drive the dollar down. So those are some whys that we can't predict timing of, but it sure seems as if they're coming down the road. And you just have to hold your horses and remain patient and, again, continue to dollar cost average in.
Well, and you're starting to see how all these different markets are tied together, especially if you drive by a gas station this week compared to a few months ago and realize that gas, at least in my area, is up 60 cents a gallon. So the increased expense cost of living causes a decrease in investment money because you have less money to go into the investment world because you're putting that money into goods and services that you need on a daily basis, causes less funds going into the equities market. Equities market begins to stagnate. Equities market rolls over. The only solution to that problem when the general public isn't investing is more government intervention on top of COVID stimulus. See, and this is why, despite my constant joke about fundamentals, the reality is fundamentals set the trend. You leave New York City, you know you're arriving in Los Angeles. Now, that doesn't mean that the road isn't going to go left and right occasionally. You can't just point your car west and go to sleep. You do have to pay attention to the technical road as you're getting there. But ultimately, it's the fundamentals that set the trend. And the fundamentals going forward are spending. I don't even know if there's a second line item. It's like a bullet list that only has one bullet on it, right?
Spend.
Print. How do we solve this problem? Print.
Yeah.
So what is it when all you have is a hammer, everything looks like a nail? It's the only item on the to-do list in Washington.
It seems like they've thrown the idea of caring about what happens in the long term to just dealing with the immediate, and that's it. They're not saying, oh, okay, what long-term effects or even medium-term effects is this going to have on the world, on the dollar, on our power, blah, blah, blah. They're just dealing with the immediate.
There's not even a debt ceiling discussion anymore.
It's all reactionary.
Deal with the immediate. What's the solution? Print more money. That's the world we're in. And so there's just this lack of care about what's the actual influence going to be, medium term, long term, on the dollar. I mean, obviously, we have been talking on the show about the dollar index going to 80. You know, Tori's been saying that it's going there because of what the fundamentals are. So the technicals are going to reflect that. And so dollar index here at 91, we started this show 2017, and we were talking about the dollar. It was a lot higher then. And we drew this trend line along the bottom that if you extend this trend line, like we've pointed out on the show for the last 4 years or so, that's where we are right now with the price, right at 91. That trend line that we drew 4 years ago, it's hitting that exactly, and it's showing that that has some kind of influence. And so whether the dollar wants to rally a little bit more or not, it is going lower because of the fundamentals of print money. Don't care about the future. Just deal with it now. Print money.
Well, and the dollar index gives us a fantastic example of this trend change that we're talking about, this excessive money printing trend change, because when we came down in the dollar index and we broke below that declining trend line here a month or so ago, we're talking about pretty massive RSI divergence going into it. We're coming into the 618 fib from the beginning of the bull market rise in the dollar back in 2014. I mean, you're talking about a pretty massive support level. Also coming into the lowest pricing the dollar had been between like 2014 and 2020, back when it took that dip down at the end of 2017. So there are a lot of reasons why the dollar should be having a very aggressive move up right now. Even if it is going to trend and continue down, the dollar should, from a charting perspective, be coming up, and it's just been a dead cat. I mean, it hasn't done anything to the upside. So the dollar went down to 89.5, it's up to 91. There's no reason the dollar shouldn't be pushing up to 94, 95, 96. I mean, give us something that actually looks like a rebound. Just from where the last high was, up around just shy of 103. Even 96 would be a 50% retracement. That'd be a pretty healthy bounce on the way down. We haven't done anything up in the dollar. So everybody knows that the value of the dollar is going down. Nobody's buying those treasury bills. So lo and behold, oil's up substantially, copper's up substantially, precious metals will be soon to follow, along with other commodities, and the cost of a gallon of gas is up. So your expenses are going up. That's less money in the equities market. We expect an equities market rollover unless they pull out the one bullet they have in the chamber, and that's just print more money. And all that does is make the problem bigger, but push it slightly farther down the road.
That does it for Golden Rule Radio. You can like us on Facebook at McIlvaney Financial. Follow us on Twitter at ICA Gold. Our website, McIlvaney.com, or give us a call at 800-525-9556. Thanks for listening. Have a great week.